It will lower your tax outgo considerably, considering the fact, let's say, instead of that, if you had invested in an FD, you would be taxed on all the gains you would have got in that FD. But here, in 3 years, let's say you get 23%, but the first 15% would be exempted because of the indexation benefit, and you'll be taxed only on the 8%. That is much less than getting taxed on complete income.
On December 4, 2019, the Cabinet Committee on Economic Affairs, led by Prime Minister Narendra Modi, approved the establishment of the Bharat Bond Exchange Trade Funds with the goal of enhancing the corporate bond market and lowering borrowing costs due to their ability to invest in a variety of assets. ETFs have grown to be a popular investment tool, including the Bharat Bond ETF. It is the nation's first state-run company-issued corporate bond ETF that is traded on bourses and invested in the debt of public sector enterprises. Currently, the ETF solely purchases public sector bonds with a AAA rating. Beginning in April 2032, the ETF will follow the Nifty Bharat Bond Index, a basket of bonds issued by public sector companies or any government organization. The Bharat Bond ETF will be tradable on the stock exchange. The bond now has multiple maturity series, with each series having a separate index of the same maturity series. Apart from that, there are PSU index fund which track portfolio of government and state bonds. The index will be created by the National Stock Exchange, and the ETF will be introduced every 6 months. Indexation benefits. Indexation is inflation adjustment and a useful method for reducing an investor's tax on returns. Indexation enables the investor to adjust the investment's purchase price to reflect inflation. Long-term returns on investments are affected by it and can be adjusted accordingly with higher purchase prices resulting from higher inflation. This lowers taxes in the long term. ETFs provide more tax efficiency compared to bonds, as coupons from the bonds are taxed at marginal rates while bond ETFs are taxed with the benefit of indexation, which significantly reduces the tax on the return for investors. As Bharat Bond ETF will be investing in fixed income securities, debt taxation will be applicable, in contrast to other bonds. The Bharat Bond ETF has the same taxability as debt mutual funds, which means that short-term capital gains are taxed at a marginal rate and long-term capital gains after 3 years are taxed at a 20% post-indexation benefit on Bharat Bond. So, investors holding the fund for more than 3 years would only have to pay a 20% tax after indexation on returns, making the Bharat Bond ETFs the most tax-efficient option for investors among other bond options. The debt mutual fund do not have fixed maturity, which means they keep buying new securities to keep holding period constant. This makes them susceptible to interest rate risk when in a rising interest rate scenario. The Bharat Bond ETF terms and returns. The Bharat Bond ETF offers 5 maturity terms currently: 1, 2, 8, 9, and 10 years. PSU index fund is available for 3, 4, and 5 years. The Bharat Bond ETF invests in bonds issued by public sector entities such as PFC, National Housing Bank, NHPC, Indian Railway Finance Corporation, and others. It invests in bonds with high-quality ratings such as AAA and equivalent. The tenures being offered come with interest rates that get locked in at the time of picking up the NFO. If held until maturity, the interest rate realized at redemption will be the yield on 3-year CPSE bonds, which is around 6%, and the yield on 10-year CPSE bonds, which is around 7%. If sold before maturity, the ETF unit's earnings realized will be based on either their net asset value or their market price, depending on whom they are sold to, resulting in the bond ETFs functioning like fixed income instruments if held until maturity. The fund's returns are stable and predictable thanks to the roll-down or target maturity method. The underlying bonds' coupon payments are not given to investors until they mature. Instead, they are reinvested in the fund to increase returns. The ETF units may be sold on the secondary market and the market price received in exchange if one is unable to complete the tenure. Bharat Bond ETF alternative. There are few PSU debt index fund in the Bharat Bond series. Investor can target their required yield and tenor and then choose the debt index fund or ETF accordingly. Now let's have a look at my portfolio.
In this video, I'll show you how you can buy the bond ETF, and the current yields of these bond ETFs can also be seen in the website. So this is the Edelweiss site where you can see the current yields of different bond ETF. For instance, the Bharat Bond ETF, which is maturing in 2023, the current yield is 6.35, and for August 2022 it's 6.91. Then there are the PSU index fund, which is not an ETF but an index fund which tracks bond index, which comprises government and state bonds. So now if someone wants to get some tax benefit, they need to hold the bond for 3 years. So we will be only going for those bonds which have at least 3 years of maturity left. For instance, for us, this makes sense because it's maturing in October 2025. It means we have more than 3 years to invest, and we'll be getting a yield of 7%. Now the important part is that this 7% you're getting, but how much is the tax? For this investment, you'll have to first factor in the indexation benefit which you get because you're investing in index fund. So you can check the income tax site which provides the various indexation levels for various years, so which is generally around 5% a year. So for instance, if you invested in 2020 and you hold for 3 years, so you have to check the base indexation rate in that year and the current year, and with that factor you change your acquisition cost of that fund. So I'll show you an example. So you can see, let's say if initially you invested 10 lakh, you invested in 2001, 2002, and at that time index CII was 100, and now it is 272. So you have to change your acquisition cost by that factor. So in this case it becomes 27 lakhs instead of 10 lakhs, and whatever you gain on this would be taxed at 20% because it is a bond investment. So that way it will lower your tax outgo considerably, considering the fact, let's say instead of that, if you had invested in an FD and the FD returns were, let's say, 6%, but you would be taxed on all the gains you would have got in that FD. But here, out of that, let's say you gain in 3 years, let's say you gain 23%, but the first 15% would be exempted because of the indexation benefit, and you'll be taxed only on the 8%. So let's say if you tax 30% on 8%, that's 2.4% on your total income. So that is much less than getting taxed on the complete income. So now you know the benefit of having this product. Now from where you can buy this product. So for the ETF, it is very simple. You can buy it through your Zerodha terminal or any broking account. It is traded like a stock. I suggest people to put a limit order. So first you need to check the current yield. So let's say I check the current yield of the product, and if that makes sense to me at this current price, I'll buy it using a limit order, and it will show like any other stock. So for the index fund, let's say if you want to buy the 2025 yield wise index fund, you can check the current and you can just place a buy order and it will be executed. You can use the Edelweiss website also for this, or if you have any other mutual fund platform like Grow, you can also use that. There's not much difference. So I think it's a very good investment because the tax outgo is quite less. If you're making 7% and you're just paying 10% on the on it, so you eventually you're ending up around 6.3% return in 3 years, which is very good. The advantage of having a bond fund, fixed maturity fund, is that there's no duration risk, because once you invested in a particular yield, you're locked in that yield. There will be fluctuation, but at the end of the day you will get that amount at which you have locked that yield. If for instance if you go for a medium duration mutual fund, there's a risk of interest rate because they're always holding the same holding period throughout the investment horizon. So it means that every day they're buying and selling securities to have that 3-year tenure, so they have a higher interest rate risk. For you to make sense to invest in different products, you need to think that after tax how much will be making. So if you're making 8%, 7% in a high risk product, it's better to invest in a 6% product which is lower risk and lower tax. But if you're making 10%, then it makes more sense to invest in that product because after tax you're making 7%, which is higher than, let's say, 5%. So that way you should do your risk reward analysis when you're investing.
You can read the full blog on this topic by using the link provided in the description. That's it for this video. If you enjoyed it, then hit the subscribe button and turn on the notification for future video updates. Also, share your reviews in the comment section. See you in the next video. Till then, bye bye.